In today's episode, I'll talk about two very interesting stories. In the first story, I'll talk about India's fiscal deficit and we'll understand why it is at an all time high right now. And in the second story for the day, I'll talk about the investment outlook that multiple banks and financial institutions have while we are ending the year this time around. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy to understand, yet one level deeper as compared to traditional news channels. I'm your host Anurag Bansal, and today is Tuesday, the 24th of December. In the first story of the day, let's break down a complex topic that has been making headlines as of late: India's fiscal deficit. Now, if that term sounds unfamiliar to you, please do not worry. By the end of this, it'll feel a lot more approachable. See, India's fiscal deficit, which is basically the gap between how much the government spends and how much it earns, had reached a record 9.2% of the country's GDP during the time of the pandemic. Now, that is the highest that it has been in the last few decades. To give you some context, a fiscal deficit is like spending more than you earn. Imagine you're running your household budget with about 100 rupees coming in every single month, but you're spending 120 rupees. In this case, you obviously need to borrow the extra 20 rupees, right? That is exactly what happens when governments run fiscal deficits. Now, 9.2% to you might sound alarming, and you might wonder, why did the government let this deficit balloon in the first place? Or do you think this means India is heading towards an economic disaster? In this story today, let's explore these very questions step by step. But before we get into the details, let's first understand in better detail what a fiscal deficit exactly is and why it matters to someone like you and me. Look, governments earn more money primarily through taxes like income tax, GST, and corporate tax. They spend this money on running the country basically, on things like infrastructure projects which are building roads or railways, etc., paying salaries to people, funding schools, and other similar projects. Now, while the government spends more than it earns, it also borrows money to make up for that particular difference. This particular borrowing that I'm talking about is called the fiscal deficit. Now, know that a small deficit over here is pretty normal. Most countries have one because it is very hard to balance spending and earnings absolutely perfectly. But the problem happens when the deficit grows too big. And in this case, it can create some problems like inflation, higher borrowing costs, or even a debt crisis. Think of it like managing a credit card debt. If you borrow money wisely for something that's useful, say college education as an example, you can pay it off later. But if you borrow recklessly for things that do not quite add value to your life, you risk financial trouble for yourself. So the question is, why did India's deficit increase so much over here? Look, the answer lies in the pandemic itself. Look, the COVID-19 pandemic was not just an ordinary economic slowdown. It brought the entire world to a halt. Businesses shut down, people lost jobs, and economic activity practically froze. Governments across the world faced massive challenges. They had questions on how they could support people and businesses during these difficult times. Closer to home in India, the government had no choice but to step in and spend heavily. They prioritized areas like healthcare, which is building medical infrastructure and providing vaccines. They also spent on food distribution, which was to ensure that nobody went hungry during the particular lockdowns that we had. There was also direct cash transfers, which involved putting money directly into the hands of those who needed it the most during these times. There were also employment programs that the government ran, like expanding initiatives like Manrega in order to offer work in rural areas. Now, economists call this approach as counter-cyclical fiscal policy. Look, when private businesses and individual spending starts to collapse, government steps in to fill the gap by spending more. Without this intervention, the economic damage could have been absolutely catastrophic. And here is where it gets a little more interesting. Look, like I said, not all deficits are bad. What really matters is how the borrowed money is actually used at the end. Good deficits are things where government borrows to invest in things like roads, railways, or power plants because these are productive assets. They create jobs, improve efficiency, and boost long-term economic growth. Now, economists call this capital formation. On the other hand, a bad deficit is if borrowed money is spent on things with no long-lasting benefits. For example, excessive subsidies or poorly targeted welfare. Now, this can create problems because over time, this kind of spending increases debt without quite improving the economy's capacity to grow. Now, India's pandemic spending struck a balance here. While a chunk of it went towards immediate relief like food distribution and cash transfers, a significant portion was also invested in infrastructure projects. To give you an example, the government at that particular time also invested in road and railway development. States received funds for their own development initiatives as well. And this focus on long term investments helped cushion the economy during the pandemic and also set the stage for growth in the next few years to come. Now, a little away from home, countries like Greece have in the past struggled with high deficits, which had led to inflation, currency devaluation, and also crippling debt. So the question here is, why hasn't India faced such similar problems? See, there are three key reasons over here. The first one is domestic debt financing. See, most of India's debt is owed to domestic lenders, which are banks, insurance companies, and citizens. This internal financing reduces risks like currency depreciation or sudden demands from foreign lenders. The second thing is strong financial markets. See, India's financial system has enough liquidity right now to absorb government borrowing. Unlike advanced economies where high government borrowing can crowd out private investments, which means making loans expensive for businesses, India has avoided this problem very well so far. The third thing is growing out of debt. Look, India's economy is growing faster than the interest rates on its debt. This means that our country can manage our debt sustainably because long-term growth outpaces borrowing costs. Now, a study by the National Institute of Public Finance and Policy, or the NIPFP, sheds some light on why exactly India's fiscal deficit has not caused any major disruptions. The first reason is that there was minimal impact on interest rates. Look, unlike some countries, India's fiscal deficit has not quite significantly driven up borrowing costs. Factors like inflation expectations and global capital flows have played a bigger role in determining interest rates. The second reason is RBI's liquidity measures. Look, the RBI has played a very crucial role over here by keeping the entire financial system very stable. It has kept short-term rates low in order to encourage borrowing, and it has used tools like the variable rate reverse repo or the VRRR and Operation Twist to manage long-term borrowing costs. India's fiscal deficit during the pandemic was honestly not a disaster. It was a necessary response to an unprecedented crisis. Thanks to the thoughtful management and structural advantages, the country was able to avoid the pitfalls which other countries had faced. But as with anything, balance here is crucial. Deficits, just like fire, can be very constructive when they are controlled, but they can be really destructive if it is left unchecked. India's challenge now is very clear. Maintain fiscal discipline while investing in areas that ensure growth and stability for the future. With that, let's move on to the second story. Look, every year as December starts to roll in, banks and investment firms release their big forecast for the coming year. These predictions, which are often titled as investment outlooks, are almost like horoscopes for the economy. They are fascinating, sometimes even useful, but often off the mark. Now, while they do not always get things right, these reports are good for two reasons. They gather interesting data points and they help us understand what the majority of investors and analysts are thinking. So in this story today, let me dive into what some big names like Goldman Sachs, UBS, Axis Bank, and Franklin Templeton are predicting for India in the year 2025. Now, there's a lot to talk about here, from GDP growth and corporate earnings to valuations, inflation, and even Donald Trump's potential impact on global trade. So let's take it step by step. The first thing everyone looks at is GDP growth, which is basically how much the economy is expected to expand. Now, most banks agree that India's growth in the financial year 25-26, which is FY 2026, will be around 6.5% to 7%. Now, that is healthy, but not extraordinary for a country like India. Goldman Sachs is slightly more cautious over here. They are putting growth at about 6.3%, and let me tell you why. First, public spending is slowing down. See, between 2021 and 2024, government spending was slowing down at a rapid pace, about 30% year on year. But in FY 2025, it has barely been growing in single digits. That is a big drop, and it is showing in the numbers. The second thing is that credit growth is cooling off. See, credit growth, which is the total amount of loans that banks are giving out, has slowed down from 16% in FY24 to about 12.8% in October of FY 2025. You might ask why? That is because the RBI has been tightening rules on unsecured loans like personal loans since late 2023 in order to avoid risks, and we are now seeing the effects of it. But the good news is that it's not all bad news. There are some bright spots that could keep India's economy stable over here. The first is stable welfare schemes. See, over the past few years or so, Indian states have rolled out massive income transfer schemes for women. These programs now transfer about 2 trillion Indian rupees annually, which is 0.6% of India's GDP, to around 134 million women. Axis Bank's research shows that these schemes are boosting household spending by 7 to 45% in target segments. That's a big support for consumption, and it's not been talked about enough, to be honest. The second thing is corporate earnings. Corporate earnings, which is how much money companies are making, are a key indicator of markets' health as well. And let me give you the outlook over here. Standard Chartered Bank is predicting that Nifty 50 earnings will grow by 7% in FY 2025, then accelerate to 14% in FY 2026 and 12% in FY 2027. Mid and small cap companies, on the other hand, are expected to do even better. They are expected to grow their earnings by about 27 and 25% respectively in FY 2026. But on the other hand, like always, Goldman Sachs has a slightly different view. They expect the MSCI India earnings to grow by 12% in 2024 and 13% in 2025, which is below what most analysts are expecting at 13 and 16%. Valuations tell us how expensive stocks are compared to their earnings. Right now, the Nifty 50 is trading at a forward price to earnings or a PE ratio of 20.2x. That is below the recent peak of 23x, but it is still higher than the long-term average of 18.2 times. Goldman Sachs thinks that the Nifty could hit 27,000 points by the end of 2025, but they also warn that this journey could be very bumpy. Why, you might ask? That is because valuations might need some more time in order to align with their earnings growth. Then the big question is, what is the RBI likely to do with interest rates in the year 2025? See, most banks think that central banks will start cutting interest rates, but only slightly. Standard Bank predicts a shallow rate cut cycle with rates dropping by about 50 to 75 basis points, which by the way is 0.5 to 0.75% starting from Q1 of FY 2025. You might ask, why are they so cautious? See, that is because inflation is still a concern and the economy might see a slight growth uptick which limits how much the RBI can cut interest rates. On the bond side, they expect government bond yields to stay between 6.5% and 6.75%, which makes high-quality corporate bonds an attractive option for investors. Now, while we're at it, let's also talk about where the money might flow in 2025. Franklin Templeton is bullish on 3 sectors. The first one, they say, is banks. With strong growth and relatively cheaper valuations right now, they look like a good bet. The second one, they say, is consumer companies. See, there's a growing trend of premiumization here, which is driving profits in this sector. The third one is the auto industry. See, there is a rising popularity of SUVs, which signals that the Indian consumer is upgrading their spending. Another dark horse over here is real estate. Banks that we're talking about believes that India is at the start of a multi-year real estate boom. And that is because property inventories in major cities are at 15-year lows, which typically signals a surge in new construction. This could benefit sectors like cement, steel, and consumer durables. Axis Bank data shows an interesting trend over here. Over the long term, core inflation, which excludes food and fuel, and food inflation trend move together. Both of these have risen by about 120 to 125% between the year 2011 and 2024. Currently, food prices are unusually high compared to core inflation. This means either food prices will fall or other prices will rise to catch up. Now, let's also not forget about global challenges over here. When Donald Trump returns to the US presidency in 2025, it could heavily shake up global trades. UBS sees 3 ways that it might affect India. First, there could be slower global growth. See, a weaker US and China could drag down global demand, which could eventually affect India's exports. The second thing could be capex delays. See, if China starts dumping excess manufacturing capacity, it could discourage Indian companies from investing in new projects. The third thing is trade imbalance. Look, a weaker Chinese currency might hurt India's trade balance. But there is an upside to this. Standard Bank believes Trump's policy could accelerate the China Plus One trend, where companies move supply chains out of China. And over here, India could benefit from diversification. Foreign investors pulled out a massive 94,000 crore rupees from Indian equities in late 2023. But domestic institutions have stepped in by buying 59,000 crore rupees of them. UBS points out that India's equity market is now the 4th largest globally with a market cap of around $5 trillion US. This makes us more exposed to global flows, which could eventually mean more volatility. So, in the big picture, yes, there are a lot of challenges. There is food inflation, there are Trump's trade policies, and China's slowdown, etc. But most banks agree that India's growth story does remain intact. The structural drivers, which are rising investments, improving corporate profits, and a shift from consumption led investment led growth, are still very, very strong. So, 2025 might seem like a bit of a pause, but it's not at all a problem. Let's then move on to the final section of the day and talk about the quick news tidbits. First, the Indian government has injected 500 crore rupees into the Industrial Finance Corporation of India, or the IFCI, maintaining its 71.72% ownership stake. This funding, which is approved as part of the first supplementary demand for grants 24-25, bolsters IFCI's financial strength without adding to fiscal pressures, as the funds are sourced from savings in other grants. This also marks IFCI's second significant capital infusion this year, following 500 crore rupees raised earlier through equity shares. Second, in the venture capital space, India recorded 16.77 billion US dollars in funding across 888 deals between January and November of 2024. This represents a 14.1% rise in deal value and 21.8% increase in deal volume as compared to the previous year, 2023. The technology sector led here with 6.5 billion US dollars as investments, which is a 52.5% jump year over year, and was followed by consumer discretionary and healthcare. Notable deals included Zepto's 1.3 billion US dollar funding and Poolside AI's 500 million US dollar fundraise. Third and the final one, gold loan NBFCs are seeing a rise in auctions as regulatory oversight is tightening. For example, Muthoot Finance auctioned gold worth 69 crore rupees in quarter 1, escalating to 250 crore rupees in quarter 2. Manappuram Finance also auctioned gold worth 360 crore rupees in quarter 2 and complied with the RBI's 75% loan to value, or LTV cap, with an average LTV of 58%. Meanwhile, bank credit against gold jewelry had surged by 56.2% year on year as of October 2024, compared to 13.1% growth in the same period last year. That's all the news and stories I have for you today. I hope you enjoyed this show and maybe learned something new from it today. This is your host Anurag Bansal signing off. I'll see you in the next episode. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.